Markets. Let's bring in Citi U.S. equity strategist Scott Chronert to discuss what we have here, Scott, at record highs again, very resilient tape. Familiar story, right? Elevated valuations by every measure, but when earnings are growing and the Fed is tilted lower with rates, usually that doesn't necessarily lead to bad things. But how do you see it?
Well, there's certainly been a mantra that's come in the market recently with don't fight the Fed with this latest Fed cut. I get that. But to your point, we're looking at very extended valuations, which is an issue and a cause for concern. The way we like to bucket, though, is that it's not the valuation circumstance itself that's the issue. It really keeps coming back to the ability of earnings and fundamentals to justify said valuations. And you look back at historically in previous points in time where there's been this much being paid in the market for, let's call it, a new growth paradigm. Usually what brings the bull market to an end is that coming to an end as well, that underlying fundamental premise. That happened with the tech bubble burst. It happened at the end of 2021. So from here, we're in a similar starting point. The question is, how long and persistent can this AI tailwind be in terms of supporting a fairly visible fundamental outlook? As long as we see that visibility, equities are going to be in good shape.
I mean, yesterday, I think NVIDIA added $160 billion in market cap just on this announcement. I mean, it doesn't look like we're anywhere near the end of this AI growth tailwind.
No, I think what we have to be sensitive to, and one of the things that we keep coming back to, is the massive free cash generation that's coming from these companies as their business models continue to mature, right? And you see this revenue conversion down to free cash, it gives these companies just so much financial flexibility. So one of the games that we're going to be watching here is the ability of these companies to continue to moat build, whether it's buying new technologies, whether it's buying potential sources of future demand and so forth. They can do it. They've got the free cash generation to do it. It perpetuates the theme here. Does bring into question in terms of is this going to continue to be a bigger dynamic, and so far the fundamentals are saying that it can stay that way.
I like the way you put that, buying demand, because some of the desk notes are like, we didn't think we'd be this early in the process. We didn't see, I think it was one desk note that said paying people to buy your products. Yeah. Right, that was sort of the knock on yesterday's announcement. Yeah. Does that make any sense?
Well, again, I'm going to put it in this bucket of moat building, right? And the difference here, we keep going back to this tech bubble analogy. Back then, what was happening is that you had a lot of IPO and funding proceeds. That was your source of revenue for doing all of this, right? It created a little bit of a fundamental house of cards. So where one part kind of came unglued, the whole thing tumbled. That's not the case here. These companies are in position to do this. I like to point out that if you look at the Mag 7, okay, as an example, 5 of that Mag 7, despite everything going on with CapEx and everything, are still reducing fully diluted share count. So again, I come back to, you got the financial flexibility to do this, why not?
Yeah, they sort of operate in a world where they don't have painful trade-offs to make, right? There's enough to go around. On the other hand, they are using that free cash flow in large part to rebuild a moat or extend a moat or whatever they might be doing. And I just wonder if at some point there's going to be this realization of, well, part of it is out of desperation or fear that, in fact, what they have right now would otherwise be vulnerable. I can't get around the idea of Meta paying 9 figures for talent if they didn't think they were going to be hurt on the other side.